This voice is taken from an article with the title, How to Manage Risk When Trading on Lower Timeframes, which has been published on TraderTalks.net. When trading on lower timeframes, managing risk is of utmost importance. The key to successful trading is to limit your losses and maximize your profits. Risk management is an essential part of trading on lower time frames. The first step to managing risk when trading on lower time frames is to set a stop loss. A stop loss is an order that limits your risk by closing out a position at a predetermined price level. This prevents large losses in the event of a sudden market move. It is important to set a stop loss at a level that is appropriate for the market conditions and your risk tolerance. The next step is to set a take-profit target. A take-profit target is an order that exits a position at a predetermined price level when the market has moved in your favor. This allows you to lock in profits and limit your risk. It is important to set a take-profit target at a level that is appropriate for the market conditions and your risk tolerance. The third step is to set a risk-reward ratio. A risk-reward ratio is a ratio of the potent IAL profit to the potential loss on a trade. It is important to set a risk-reward ratio that is appropriate for the market conditions and your risk tolerance. The fourth step is to diversify your TRA. Diversification is a risk management strategy that involves spreading out your risk across different markets. This reduces your risk exposure by limiting the impact of any one market move. The fifth step is to use leverage carefully. Leverage is the use of borrowed funds to increase the size of your position. It can increase your profits, but it also increases the risk of losing your investment. It is important to use leverage in a way that is appropriate for the market conditions and your risk tolerance. The sixth step is to use technical analysis to identify entry and exit points. Technical analysis is the study of past price movements in order to identify potential trading opportunities. It is important to use technical analysis to identify entry and exit points that are appropriate for the market conditions and your risk tolerance. The seventh step is to use risk management tools. Risk management tools such as trailing stops, time stops, and volatility stops are used to manage risk when trading on lower time frames. These tools allow you to limit your losses and maximize your profits. The eighth step is to use a trading plan. A trading plan is a set of rules that you follow when trading. It should include the entry and exit points, stop losses, take profit targets, risk-reward ratios, and other risk management techniques. These 8 steps will help you manage risk when trading on lower time frames. It is important to remember that there is no one-size-fits-all approach to risk management. Each trader must decide what risk management techniques are appropriate for their trading style and risk tolerance.